section, we look at the rise of sustainable investing and also what kind of solutions are available through ETFs.
I think the rationale is it's not just performance, it's not just risk versus performance, it's an emotional benefit for a certain type of clients. It's not going to be the majority of clients, but it's a niche that should not be neglected.
But ESG can be quite subjective. So what ESG means to one person is different from what it does to another. So how do you, as a fund analyst, how do you go about and select these ETFs, or how do you build these kind of products?
I think that there is two very essential steps. First, you have to well categorize each ETF, because there are plenty of methodology, best in class, exclusion, impact. So you have to be well aware of the strategy behind each ETF and the philosophy. And then you have the second step, which is a discussion with the client. Which kind of impact the client want to have with its portfolio, and then you have to reconcile the two aspects. So it's really a bespoke approach that you have to put in place with your clients.
Mm-hmm. If I may take up, I think Felix was spot on that ESG is a very emotional topic. So as investors, we're trying to quantify an emotion, which is very challenging. So from a screening perspective, it's so important. It's really important to understand what are the emotions that are important, what are the values that are important to our private investors. And I think this is where ETFs actually do add a lot of value from an ESG perspective, because they lend themselves for the screening, for example. So exclusionary screens, it's a very simple methodology that can be used, and it's very transparent. And so if we have investors who don't want weapons or whatever, it's very simple. And if you think about the impact factors, it's also ETFs, I think, lend themselves quite easily to be able to implement impact factors in terms of the client wants more exposure. Social and financial, so gender diversity, so they want to invest, companies with the SHE ETF, for example, or water, or there's different ETFs out there. So I think there's those two sides. But then I think you have the middle ground, which is where becomes more challenging is like, for example, carbon footprints, this company's carbon footprint, or this company's, child laborers, or et cetera, et cetera. That's where it starts becoming a little more fuzzy in terms of simple ETF positioning.
But one of the problems with smart beta and ESG ETFs is that, we know that bigger is better for ETFs. So Bernard, how difficult is it to draw assets, to each of these different ESG ETFs?
Being an ETF issuer, we try to bring products to the market that are relevant for as many investors as possible. Right. Because every investor is happy if an ETF is larger and the liquidity is better. On the ESG side, obviously we have so many different definitions, and if you talk, especially on the institutional side, where we have a lot of conversations on the ESG side, many investors define ESG differently, and I think similarly on the private wealth side, probably even more, because private individuals have all their in the individual style. So this makes it difficult to issue one single product and say, this is my ESG solution for the market, and that's it.
So how do you face this issue?
We in UCITS, for example, on the pure ETF side, in the UCITS structure currently, we do not offer any ETFs. The beauty working for a leading global asset manager is we have solutions on the index fund side, which are broader on the fixed income and on the equity side. But in the US, we also have certain ESG related ETFs. You mentioned SHE, which was a success there, which also corresponds to our to our demand of gender equality, which is really a top of the house issue for us. Coming back to your question again, I think it is a challenge, and I think I think we're still in the early stages of there are a lot of ESG ETFs out there already, but I think we're still in the early stages of development.
I think
even earlier than in smart beta, and if you want to make it more complicated, we can even argue ESG as a factor should be included there. I think we had a discussion on that, Romeo, a couple of months ago.
Do you think it's a factor, ESG can act as a factor?
State Street Global Advisors thinks it is a relevant factor, yes. Yeah. But I wouldn't say it's only a feel-good factor, because there are various studies that it also adds value in a long-term portfolio.
I would prefer a broad S&P ESG style with, in this case, big is beautiful, I should say, in terms of issuer. Because we know that the resources in terms of IT, quant machine and so on, deep learning machine and so on, are mainly in the big asset managers. I am more comfortable to buy an ESG on broad index using methodology well known. And also, I know that in the process, the issuer will have all the power in terms of IT stuff and so on to calibrate properly and to deliver. Right, because at this stage, we will discuss after. It's in this kind of strategy you could have a reputation risk, not only a risk on your investment, but if you say, okay, I put 500 million on this ESG on a Sunday morning, you just learn in the front page of the Financial Times that there were an issue is in this company, and this company is perhaps the third weight in the ESG index. Not good at all.
I agree with Jacques' point that if you go in very particular, very specific sector, and you say you want to have ESG, then you end up with this reputation risk, because you have some names always, right, that can make up, 5% or so, and then you don't want to read that name for a scandal. And you've sold it to your clients as all the good companies, right? So you have to be careful with this.
As of today, we're really looking at exclusionary types, but this is why we discussed the factors. But I think going forward, it's going to be more about impact. It's going to be more about how we reflect their views. And going back to stewardship, I think is really important. Reputational risk is important, but a company who has a diverse board of directors, of females, who has good labor laws in place, they avoid frauds, they avoid strikes. So those companies should perform well going forward, technically speaking, right? Given all other factors are equal. So I think also from that perspective, it's not just about excluding companies, it's also about what companies are actually
championing the
Exactly. So I think from looking at our book of work, this is what we're focusing on. So we have the exclusionary side, but we're really looking not only to map our clients' interests and beliefs, but also to create solutions and building blocks for them, especially for the future generation or the next generation that is really going to start then taking action on that wealth that's been accumulated.